Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest is Peter Moss, and Peter is a mortgage broker at WiMAC Capital, and they're in the Bay Area here. So as we get started, we've got a few disclaimers and disclosures here that Peter has given me. One is that Peter's views and his comments may not necessarily be those of WiMAC Capital. Okay. Also, by way of disclosure, I'm a licensed California real estate broker myself, and I have a mortgage endorsement with the NMLS. NMLS number is 31 with 4 zeros after it. Peter's real estate number is 01253202. His NMLS number is 298243. So these are just government required disclosures when you're doing any sort of communications related to mortgage. I've been affiliated with WiMAC myself for over 12 years, so I've known Peter for quite a while. Peter, he said I could say that he's now soon 68. I mean, so there you go. I mean, talk about full disclosure, right, folks? Anyway, he's been an investor for a long time, loves to follow economics. He started investing his lawn mowing earnings at age 13. I don't have time to go over all this stuff, Peter, but anyway, he's done a lot of things over the years in technology as well. So he actually helped Charles Schwab set up some of their internet operations. His first job was in financial services at Ernst & Young in Chicago, and he was involved in some savings and loan audits there and so forth. And let's see here, he said that when Charles Schwab did a merger with Bank of America, I guess, he pursued some consultancies with several dozen Bay Area small firm CEOs, as well as Intel and Hewlett-Packard. So again, he's got these intertwining experiences with technology and finance and so forth. It makes him a very interesting person. And he was a client with Charles Schwab, he says, for a year, starting when they had 5 employees, so that's a long time ago, and he advocated that Schwab take computing in-house, and so they used a system then that Peter co-designed in 1978, so this is even before the IBM PC, in partnership with the Service Bureau, and that's now owned by Thomson Reuters. Okay. Well, anyway, so we're not going to be talking about technology today, although Peter has that background, being in the area here. Mostly what we're going to be talking about is the developments that are happening in the mortgage area, things to be aware of. And as we get started with that conversation, today is November 22nd, 2016. Donald Trump has only recently been elected President of the United States. He has not been inaugurated yet. He has promised some big changes coming up, and some of these are going to affect the mortgage industry. So we get to sort of speculate a little bit about that a little bit maybe today, but also talk about some things going on in the mortgage area in general. Peter, thanks so much for joining me today.
Mike, very glad to be here.
Okay. So,
can we start talking about the big picture, and then we can work our way down?
Well, let's just go for that.
Okay.
Let's see here. So why don't you talk a little bit about what's been going on in the mortgage area overall? I think people have been hearing a lot of, at least I have, radio ads, Rocket Mortgage and all this other stuff, and movement to the internet and so on. So why don't you talk a little bit about how this is all developed?
Mortgages are so big a transaction. Typically, your largest liability by far is your first mortgage. And because of that, and because you don't typically refinance or purchase very often, doing it on the internet is a little awkward because you have to go through the learning curve. It's not like investing where you might go to your Charles Schwab or your TD Ameritrade website maybe even a couple times a week.
Mm-hmm.
You're only going to be doing a mortgage, once or twice a year at most. Recently, we had one client who refinanced 3 times in 18 months, last 18 months. But that's pretty unusual.
Mm-hmm.
So typically, the learning curve for any website is significant.
Mm-hmm.
And so what hasn't happened, which many people expected to happen, was that the web would take over for mortgage brokers and mortgage agents and for banks, and it really hasn't happened.
Mm-hmm.
And that's specifically why it hasn't. It's a little bit like insurance. How often do you change insurance? How often would you need to go to an insurance website? Not very often.
Mm-hmm.
But things that you do often, like banking, does make sense. So in terms of going to the web to do your refinance, hasn't really happened. Now what has happened is e-signings for the documents have happened, and uploading all your statements, for example, is a lot easier because you can pull them down, they're PDFs, and you can ship them off securely.
Mm-hmm.
That much has happened, and it's made refinancing a whole lot easier.
Uh-huh. Uh-huh.
So that's one development. But what I'd like to do is skip to the big picture, since you mentioned the political environment and the change in administrations, and talk about really how little that may actually matter.
Okay.
Because what really counts is the long term and the big trends, which tend to, believe it or not, kind of override the administrations.
Okay.
And so if we can go to slide number 1, we can talk about the really big picture, which is in this chart, a graph of the 10-year and the 30-year constant maturity yields. These are the yields for the 10-year Treasury and the 30-year bond going all the way back to 1960. And so it gives you an idea of the big run-up, which, if you recall, was President Volcker of the Federal Reserve getting behind the puncturing of that inflationary bubble. And then the aftermath of that caused a recession, as you can see in that shaded area, directly beneath the spike. And then continuing off to the right is the future of those rates, and people have called this a 34-year or so bond market, bull market, which, as you can see from the rundown, when the yields go down, the value of the bonds go up.
Okay.
And what people have in this November timeframe after the election worried about is probably best seen on slide number 2, which gives you an idea of the last couple years where we bottomed out in terms of, and this is the inverse side, this is how much a bond is worth, in this case the 30-year bond. And just before 2014 we saw interest rates top out, and then we saw basically rates go down, which means bonds are worth more, all the way into the election. And you see the aftermath of Brexit, basically, where we had a scare and rates actually started down long before the election. They started down right after Brexit.
Okay, so the time frame on these two were quite different. On the second one, we're just looking at about a 3-year time period or so.
Mm-hmm.
And again, on that particular one, we were looking at bond prices. So when we're just pointing out what Peter was saying is that when the interest rates go down, then the bond prices go up. That makes sense, right? So that a 10% bond, for example, if the interest rates go down to 3%, then you get a premium on that bond that reduces the yield down to the 3%. So that is sort of complex stuff, folks. Sorry about that, but anyway, again, we were just trying to give you some ideas of what's going on in the long term related to the market. And so we've had a big decline over many years for the interest rates.
So going to slide 3, you'll get a sense now for, again, long term, going back to 1970. The green spikes you see going up are when the leading indicators are positive, and the red spikes going down are when the leading indicators are going negative. So this is basically the best indicator you have for recessions. And the pink areas you see going columnar on your screen are the recessions themselves. And you can see how the leading indicators basically bottom out at the bottom of each recession and then turn up and leading into a positive era on the green side. We don't go all the way into the modern era on this chart, so let's flip up into the next screen, what I call slide number 4, and gives you a better idea of what's happening right now. Doesn't display all that well, but what you can see again is the same trend going back to 1990, where rates are going down, and this shows what's called the yield curve, the spread between the 10 and the 2-year Treasury instruments, and gives you an idea how they fluctuate. And again, the downward trend in rates and yields is pretty obvious there. Going on to the next slide, what's behind what's happened recently, and this gives you some really good perspective. Driving all this is corporate earnings. And this is a chart of year-over-year growth of quarterly U.S. corporate earnings. And what you can see fairly dramatically is how they have slid gradually as the recession recovery has sort of lost momentum until the third quarter growth of earnings is pretty feeble. In fact, it's actually negative. Started being negative in the second quarter, and we had a very negative trend in the third quarter. So basically, corporations borrow primarily for their own growth. Obviously, they're buying stock back, but gives you an idea for the demand of money. In the next slide, I have labeled number 6, gives you a really good idea. I'm sorry. Yeah, that next slide.
That's number 6.
Yeah, that gives you an idea of the momentum for money in the economy. So this basically is the velocity of what the Fed calls M2, or basically the liquidity in the U.S. banking system. And you can see where the turnover of money has really fallen down.
Yeah.
Part of that was, of course, the Federal Reserve behind that, but it was basically a lack of productivity in the economy, which basically peaked all the way back in the 90s. And you can see it phasing down to the modern era. Now, part of that, of course, is just less need for money because we've automated banking to such a great degree. So you have to discount the slide a little bit by that. But going to the next slide, you can see what's really the bottom line for the here and now, which unfortunately is just November, not perhaps March or February when you're watching this. So you can see fairly dramatically the correlation here between how well we're absorbing the federal budget deficit as a function of the nation's gross domestic product. And you can see each time that we have this ratio fall into a downturn, we get a recession. Mm-hmm. And so you can see from the far right of the screen that there's at least this historical pattern. Every time we have this spike or this mound turning over, we go into another red area on the screen, which is a recessionary period.
So I think what you're saying is that the indications are about this time, it looks like the economy's softening a little bit.
That's
here.
correct.
Yeah,
That's
so,
correct.
So anyway, so this can all have some impact related to interest rates and so forth. And again, it's sort of looking at long-term trends. So folks, believe it or not, we're trying to give things to you in a visual way that hopefully you could see a little bit about what's going on. Again, this is complex stuff that economists deal with.
If we can look at that last chart again, that may be useful because it gives you a sense for the long-term momentum and how basically baked in, no matter who would have been elected president, it doesn't matter whether Democrat or Republican, a recession was likely to occur with that new presidency, no matter who it was. Now, can't jump ahead 3 months to when this is actually on the air, and may not be clear as to what's happening, but certainly the probabilities favor a recession next year in 2017 when you're watching this.
Okay, so we'll see how this develops.
So what does that mean for
Okay,
mortgages, I
okay,
guess
yeah,
is the question.
So let's get into that then.
Okay.
What does it mean for
So
mortgages?
with a recession, demand for money goes down, interest rates go down. So the end of the bull market in bonds, which would mean another refinance era, is probably not going to happen next year. It may happen the following year, but if we're going to have a recession, as that chart somewhat projects, chances are we're going to have a very busy year refinancing again and see yet lower rates than we saw in 2016,
Really?
which was not a bad year.
So you think that rates may actually go down next year? Because of course, Yellen is saying that she is thinking of increasing the short-term rates.
Let's clarify what the Federal Reserve does. The Federal Reserve basically can change rates best, and there have been exceptions and they've caused recessions when they've gone against their own formula. They look at the 6-month and 1-year and 2-year Treasury yields.
Right.
And if those yields are going up, they're pretty safe in raising prime and the benchmark rate.
Yeah.
When they're not going up, with one exception where they triggered almost immediately a recession by doing it, they don't raise rates. So what we've seen recently is those short-term treasuries have run up in yield, and so for almost any pundit I can talk to, and you'll know this when you watch it in 2017, that the December change is baked in, and it may be another incremental change coming up in the first quarter.
Okay, so we'll see what happens. It's going to be interesting. And Peter, we've eaten up a lot of time just talking about these things. So I think one of the things that you really wanted to focus on today, though, was reverse mortgages. So why don't we focus in a little bit related to those?
We talked about those last year when I was here, about this time.
Yeah,
and
nobody's going to remember that. So let's.
It's very worthwhile to do. So
there's a lot of publicity on this, a lot of ads that people have seen, you know, basically promoting this concept of using your house as a piggy bank, particularly when you're in retirement mode and so forth. So maybe you can explain it a little
Well,
bit.
we're all counseled, you know, the sound advice we hear is retire your mortgage. Keep on paying extra on your mortgage to retire it, refinance to reduce your rate.
Yes.
When people get into their golden era, and that is they're either going cold turkey into retirement or they're phasing down how much they're working and often how much they're making, take-home pay, they're in a good position to refinance perhaps for the last time because they're still making enough money. You have to qualify an income these days to refinance. However, they somewhat go over the edge and no longer usually qualify to refinance once they've retired. So the dilemma is, if you still have a mortgage, even though it may be relatively small, once you go into retirement, what do you do? Because you're stuck with that old mortgage payment. And given your retirement income, your income now doesn't go nearly as far as it should, given everybody's limitation on retirement income. You don't have a lot of Social Security no matter who you are, versus your mortgage payment, which is still at the old rate, and you may have done a 15-year fix or who knows what as your last mortgage, which means a fairly substantial payment. So the question is, why do you do that? And in reality, it's probably best then to do what finally Congress reformed, and that is a low fees reverse mortgage. Couldn't do it before because Congress basically had set the rules up, and HUD had not really tightened things up so that the only competitive reverse mortgage you could get would cost you $20,000, $25,000 in fees.
Right.
Sometimes $30,000 in fees.
And then you just sort of add that onto your mortgage.
And you rolled it into your new reverse mortgage. So it wasn't really a great consumer deal.
Yeah.
However, Congress finally prodded HUD and passed the bill. The president signed it back in 2015 and 2014, excuse me. And so now we have the option, and you can still pay a lot if you go the wrong place, but we at WIMAC are consistently doing reverse mortgages with under $1,000 in fees, typically under $800 in fees, which is the appraisal and the counseling. That's it. The lender pays everything else. And yes, it's a variable rate, but it is capped. And so now you have the ability to retire your existing mortgage, and what you don't use in your new credit line, which effectively it is, it's like a HELOC, a home equity line, then becomes a line that grows every single year and gets bigger and bigger and can even exceed the value of your home if your home's of modest value.
Yeah. So one of the things that you and I have talked about is the idea that if you're going to have one of these, well, first of all, what's age do you need to be in order to qualify?
Well, you have to be 62, and now they have deregulated one regulation, loosened it up so that the other member of your household, your spouse, could be under 62 and you could still do the reverse mortgage. What you may want to do in that case is once your spouse turns 62, you can actually refinance a reverse mortgage and get dramatically better terms. And again, it's only going to cost, and I actually did a no point, no fee reverse mortgage. It's only going to cost at most $800 if you go to the right brokerage firm to have the mortgage brokerage firm to have that done.
Okay.
And so you get much larger line, and you get quite a bit lower rate by doing that.
Right.
It's all actuarially based on your age. If someone's in their if the couple's in their 70s, they're going to get a dramatically better rate and line than if the couple were just turning 62.
Now, when you and I were talking about this some time ago, and maybe you can elaborate on this, but basically what you said, it's better to get one of these sooner than later.
And of course, there are limitations.
But as I understand it, your limit sort of increases?
Because of the power of compounding. Ben Franklin and Einstein both talked about the power of compounding. Einstein, I think, called compound interest the greatest force in the universe. In this case, the compounding actually works in your favor because your line of credit is growing more than 5% a year, and your equity typically doesn't average that much in growth. Lately it has in the Bay Area, certainly.
Yeah.
But over the long term, real estate goes up 3 or 4% per year, perhaps in value on average. And your equity line is going up by over 5% per year. So you are getting an advantage over inflation, and you are having the ability to borrow more money if you need it. If you don't need it, you don't pay for it.
Right. So anyway, it is a great tool for seniors to have as sort of a reserve, if you will, sort of a side bank account that's there if they need it. And the nice thing about it is, again, it's optional whether you have to make any payment at all.
That's correct. It definitely helps your cash flow. You still have to obviously pay your taxes and your insurance on your home and your maintenance, whatever that turns out to be. But the beauty also is that you can have a line of credit that you can use for other purposes. You're not restricted to just using it for personal purpose. Let's say you're going to go to the desert and retire, for example, from here, or go to back east or Tennessee where the cost of living is much lower, or Mexico for that matter. You can actually use that line of credit to leg into that new home and make a substantial down payment, or perhaps in some cases pay cash with your line of credit. Take your time and then sell the house. You do have a long time to liquidate, in fact, a reverse mortgage if in fact you're going to be moving out. That's one of the beauties.
Yeah, and there is the thing too that you can structure this in a lot of different ways. So some people basically they annuitize. So in a sense, they set it up so that they're getting a monthly payment from this. That again, the repayment of that is optional. It just means that it will be a debt there for your kids that they'll have to use with the house. But as I understand it, also it's non-recourse.
Yes.
So in other words, it's secured only by the house. So it's not going to be something your kids are going to be stuck with. It just means that that's what the house is going to be going for. And then, so you can have that, and you could also have some or all available as the line of credit.
The liability is also capped at 95% of the appraisal of the house when you are when the heirs do take over.
Yeah.
So you have that advantage. And it's a wonderful tool for just managing. For example, someone who does this when they're 62 can use this to avoid taking Social Security,
Yeah.
because otherwise they're going to get a lot less by taking Social Security early
Yeah.
versus waiting until they are full retirement age for Social Security and then getting much more money per month in
Okay.
Social Security.
Peter, believe it or not, we're out of time. Goes fast, doesn't it?
Great discussion.
Okay. Thank you so much for joining me and sharing this important information today.
Enjoyed it.
Folks, we hope we've given you something to think about. See you next time on Financial Insider Weekly.